Hi, I'm Benjamin Hawes of the Hawes Financial Group, where we align your personal values, vision, and wealth. Today I want to continue discussing proactive tax planning strategies by sharing one Roth IRA workaround for high-income earners. If you understand the concept of compounding interest and believe your money will grow over time, then you'd be wise to supplement pre-tax retirement plans with a Roth IRA. After all, it's the most recognized vehicle for tax-free growth and tax-free distribution. Yet high-income earners can't contribute to Roth IRAs. Per the IRS as of 2017, if you're single and earn more than $118,000, or are married and file a return jointly with income over $186,000, the IRS starts to say no can do if you try to contribute to a Roth IRA. But all hope is not lost. If you can't contribute to a Roth IRA based on income limits, there's still a way to get money into this tax-free vehicle, provided your situation is right and you follow some very specific rules. Here's how it works. Contribute to an IRA, but do not deduct the contribution as a pre-tax contribution. The IRS calls that a non-deductible IRA. Second, wait a bit while your savings hopefully accumulates. We recommend 1 year or longer. Finally, convert the tax titling for the savings to a Roth IRA for tax-free growth moving forward. Some people refer to this as a backdoor Roth IRA. Easy, right? Not so fast. Before you go and contribute to a non-deductible IRA, understand a common situation where this strategy doesn't work. The IRS has a pro rata rule in place for converting pre-tax IRAs. This means that if you have traditional IRA monies already and then decide to open a non-deductible IRA and try to convert those dollars later, the IRS views this as an action across all IRA accounts and will include your traditional IRA in the calculation of taxes. Here's the math on the taxable consequences of a conversion. You contribute $5,000 to a non-deductible IRA 1 year ago. The balance of the account grew to $6,000, meaning there was $1,000 of investment growth. You have no other deductible IRAs, and your goal is now to convert the full $6,000 non-deductible IRA balance to the Roth IRA for tax-free growth in the future. If you're in the 25% tax bracket, you will owe the IRS $250 for this conversion, or 25% of that investment growth. Now here's another example for someone with existing deductible IRAs. You contribute $5,000 to a non-deductible IRA 1 year ago. The balance of the account grew to $6,000 or $1,000 of investment growth. You also have $100,000 invested in a traditional IRA, which was once an employer-sponsored 401k plan many years ago. Your goal is now to convert the full $6,000 non-deductible IRA balance to the Roth IRA for tax-free growth in the future. If you want to convert the full $6,000, then based on the pro rata rules, approximately 95% of this balance is taxable. If you're in that 25% tax bracket, you will owe the IRS $1,429 for this conversion. So, if you don't have any other IRAs, like in the first example, this backdoor Roth IRA strategy may work for you. If you do have other IRA assets, like in example 2, there's still another workaround for the strategy. Granted, it's probably much less common. If you have an employer-sponsored retirement plan at work, such as a 401k, and it allows for non-payroll contributions, you might consider moving your traditional IRA back into the 401k. Then you could do this conversion strategy. Carefully review the plan rules, though, the investment options and management fees, and consider the balance of the traditional IRA. You'll want to ensure you aren't letting the tax tail wag the investment dog. In summary, we aren't saying this strategy is right or wrong. We do, however, want you to note the basic tax calculation before thinking that a non-deductible IRA is as good as a Roth contribution. The IRS is smarter than to allow it to be that simple.